Given how important the right side of the V concept is, you knew I wouldn't let you go without some practical examples from the real world. This first example was one of the best trades of 2023 during the Silicon Valley banking crisis. The ticker is WAL, a regional bank stock that was getting hammered during the panic back in March of 23. WAL went from the 30s or so pre-market in a pretty straight downtrend to about $8. We then put in a bottom and we get a turn. You can see so clearly how these patterns pan out in real life. You have a very clear trend down. Once that trend is turned, it's a very clear uptrend, which was fairly probable given how epic that down move was. Often, these ultra in-play stocks are exactly where you get these clean patterns. Yes, you could have bought on the left side at 10 or 11 bucks, but you wouldn't have known what your stop is, right? Could this stock have gone to 2 bucks? Could it have gone to 1 buck? Were you going to potentially hit out as it went lower and take a bunch of losses? That's the hard part about trading on the left side of the V before the turn. Once that bottom is in and you see the reversal based on prior bar highs or however you're going to judge it, maybe where that trend line broke, that's where you want to get in. And it's a totally different and improved expected value trade with a clean stop and better win rate. Another real-world example was in 2023 as well. This simple, common setup actually happened while I was at a wedding in Mexico. Crude oil was weak, it was trending lower pre-market. Then, pre-market, we started to panic and made a very clean leg down. We do a turn, as again evidenced by the break of prior bar highs, for a clean little entry, then we have a nice little leg higher that follows. You can always be buying on the way down and getting those same prices, but you don't know what your stop is. You don't know how far down this is going to go. The better expected value play is waiting for that turn. Here is a more recent example of the NASDAQ futures on July 11th, 2024 during a CPI release. Initially, we shoot higher, and that can be a great opportunity to catch a trend on that catalyst. But once we pull back, that is a huge signal that the market might have been hoping for a different number. Then, especially once we can't bounce and are consolidating around that unaffected price, the odds and expected value of some clean move higher only get worse despite the price remaining the same. I hope these examples help you start to internalize the much broader point being made when I discuss the right side of the V. This isn't just about waiting for the turn in stocks that have capitulated. Much more significantly, this is about recognizing that there are many situations where buying at the same prices can have drastically worse expected values, and many traders don't recognize that fallacy, and it meaningfully harms their trading. These simple conceptual changes can be the difference between a strategy failing versus thriving.